When we think about like physical weight,
Yeah.
it's undeniable. You pick up a heavy box, your muscles strain, your brain immediately registers the effort, right?
Oh, absolutely. It's a physical reality.
Right. And for almost all of human history, money had that exact same physical weight.
Mm.
I mean, you handed over a thick stack of bills for a major purchase, your wallet literally grew thinner in your pocket, and, your brain registered the loss. It physically hurt a little bit.
Yeah, the classic pain of paying.
Exactly.
Yeah.
But today, I mean, money has become entirely weightless. It's just invisible data. And because it's invisible, we're kind of, floated away into a tremendous amount of financial anxiety.
We really are.
Because according to a recent CNBC survey, 65% of Americans are currently living paycheck to paycheck. 65%.
And, that strain isn't just an individual struggle. It's totally systemic. If you look at the Intuit Small Business Index for 2025, the average real revenues for small businesses actually declined.
Wow, really?
Yeah, it declined by $11,850. So, I mean, the financial hardship is incredibly widespread, but the mission for us today on this deep dive is to sort through this massive stack of research we have.
And it's a huge stack today.
It really is. We're talking everything from behavioral psychology and the Dallas Fed to Morgan Stanley's 2026 energy reports and even Indian stock market strategies.
Yeah, going all over the map.
We are. But the goal is to decode how the modern financial system actually operates right now so we can map out a path of least resistance to stress-free wealth for you. Because honestly, achieving financial freedom is entirely within reach no matter where your starting line is today.
I love that. So let's just jump right into this weightless money concept, because the psychology happening like behind the glass of our phone screens is just wild.
It's fascinating, yeah.
The behavioral research calls it financial amnesia or payment depreciation. In this era of digital payments, the literal pain of paying just disappears. I mean, look at the scale of India's UPI system.
Oh, the numbers there are staggering.
In April 2025 alone, they processed an astounding 18.4 billion digital transfers. 18 billion.
In 1 month.
In 1 month. And studies consistently show that when people use cards or apps instead of physical cash, they spend roughly 12 to 18% more. To me, it's sort of like digital spending is like eating popcorn while you're completely engrossed in a movie.
Oh, that's a perfect analogy.
Right, you don't actually register the consumption until your hand, hits the greasy bottom of an empty bowl.
Yeah, that popcorn analogy captures the exact mechanism at play. When the handover of money is abstract, that friction is just gone. Your brain doesn't log the transaction as a loss at all.
It just feels like pushing a button.
Exactly. And that is exactly the behavioral gap that modern personal finance management or PFM apps are trying to bridge. They use the account aggregator framework, which is basically a secure, user consent-driven data pipeline to pull every single financial move you make into one centralized dashboard.
So you're forced to look at it.
Forced to look at it, yeah. And we're seeing 4 very distinct models emerge from this. First, you have real-time trackers. They act like a heart rate monitor for your wallet, categorizing every swipe the second it happens.
Okay, that makes sense.
Then second, you have salary day envelope builders. These immediately slice your incoming paycheck into rent, groceries, and a safe-to-spend balance. Third are the rule-based automators. They silently round up your spare change and sweep it into digital gold or fixed deposits.
Like digital spare change jars.
Exactly. And finally, you have the gamifiers, apps like CRED or Fi.
Okay, wait. Here's where I really have to push back a bit. I mean, I understand the theory of tracking your money.
Yeah.
But the gamifiers, like a confetti animation and a digital high five on my phone screen, really trick my brain into not buying a $6 latte.
I know. It
It just feels a little childish, honestly.
It totally sounds childish until you look at the behavioral economics operating beneath that confetti. It's not just a cute distraction, I promise. These apps are weaponizing deeply ingrained psychological biases to artificially restore the weight of money.
Okay, how so?
Well, take the salary day envelope builders. They leverage something called the fresh start effect. By hiding your rent and utility money in locked digital envelopes and only showing you a smaller, green, safe-to-spend balance, they remove the guilt from spending the green money.
Oh, I see.
But, and this is key, they make breaking into the hidden money feel like a massive failure. It triggers loss aversion. Then you look at the gamifiers. They use variable ratio reinforcement.
Wait, variable ratio reinforcement, which is like the exact same psychology behind a casino slot machine, right?
Precisely, yeah. You pay your utility bill on time, and you get to spin a digital wheel for a variable reward. Maybe you get 2 cents back, maybe you get $20.
So you never know what you're going to get.
Right. And that variable dopamine hit makes financially responsible behavior intrinsically rewarding. They are artificially creating payment salience. They're forcing your brain to pay attention to the invisible money.
Okay, wow. So curing your financial amnesia is step one. But once you pull the blinders off and actually see where your money is going, you usually have to deal with the baggage that's been left behind in the dark.
Yeah, the dreaded baggage.
And for most people, that baggage is debt. The Dallas Fed research we looked at is very clear on the foundational rule here.
Yeah.
You have to pay yourself first.
Even if it's a tiny amount.
Even if you are starting incredibly small. I mean, saving just $3.33 a day, which is about $100 a month, builds a $1,200 emergency fund in 1 year.
Which covers most minor emergencies.
Exactly. The trick is automating that transfer to a completely separate account so it stays entirely out of sight.
Right. And once that baseline safety net is forming, you have to attack the existing debt. Because honestly, high interest debt actively destroys wealth. It's a leak in the boat.
A huge leak.
And there are two primary schools of thought here. The Avalanche method, where you aggressively pay off the debt with the highest interest rate first, while paying minimums on the rest. And then there's the Snowball method, where you ignore the interest rates entirely and pay off the smallest balance first, rolling that freed up payment into the next smallest debt.
Now, mathematically, and people love to argue about this mathematically, the Avalanche method is the only one that makes sense.
On paper, yes.
Right. It objectively saves you the most money on interest over time. But human beings aren't spreadsheets, you know.
Definitely not.
If you have a massive high-interest student loan, you could be throwing money at it for years without feeling like you're making a dent. Don't we desperately need those quick psychological wins from the Snowball method just to keep from giving up entirely?
We absolutely do. And that is heavily supported by the McKinley-Carter research on the psychological benefits of financial freedom.
Oh, right, the cognitive load stuff.
Exactly. Debt is not just a mathematical liability, it is a heavy cognitive load. It takes up active bandwidth in your brain, causing chronic stress. So when you use the Snowball method to completely wipe out, say, a $500 credit card balance, you aren't just saving money.
You're like breathing easier.
You're literally removing a mental weight. You're freeing up cognitive bandwidth. That quick win creates a surge of hope and resilience. It builds the behavioral momentum you need to tackle the larger, more intimidating debts.
I love that phrase, behavioral momentum. And as you systematically crush that debt, you're simultaneously repairing your credit, which is basically the passport to the modern economy.
You can't do much without it.
You really can't. The Consumer Financial Protection Bureau guidelines provide the exact playbook for this. You want to keep your credit utilization, which is the amount of credit you're using compared to your total limit, under 30%. Though ideally you want it under 10%.
10 is the sweet spot.
Yeah. And if your credit is totally wrecked, you use a secured credit card where you put down a cash deposit as your limit to build a positive history. But, and this is crucial, you have to know the rules of the game here.
Yeah, there are a lot of misconceptions.
So many. Using debit cards, prepaid cards, or payday loans does absolutely nothing to build your credit score. Zero. And negative marks, like a bankruptcy, well, that's a shadow that will follow you for 7 to 10 years.
It's a long time. But once those debt leaks are plugged and your credit is stabilizing, your brain finally has the bandwidth to think about the future. You're no longer playing defense.
Right.
You're ready to play offense and actually build net worth. And to understand that, we look at the Dallas Fed's simple formula for wealth. Assets, things that earn money or appreciate minus liabilities, equals net worth.
It's that simple. Assets minus liabilities.
Yep. But to play offense, you need an engine, and that engine is compound interest. It is the financial equivalent of a snowball rolling down a long hill, gathering mass entirely on its own.
The eighth wonder of the world.
Right. That's what they say. The math is A equals P times 1 plus the rate over N, all raised to the power of NT. Basically, it's earning interest on itself.
Right, which sounds complicated, but it just means your money is making its own money.
Exactly. But to get that snowball rolling, you have to invest the money into assets. And this is where index funds enter the picture. They were pioneered by John Bogle at Vanguard back in 1974.
A legend.
Absolute legend. They operate on the efficient market hypothesis, meaning instead of paying some guy in a suit to try and pick winning stocks, the fund just tracks preset rules to replicate a massive basket of securities, like the entire S&P 500.
Just buy the whole haystack instead of looking for the needle.
Exactly. And the magic is in the fees. An index fund might charge you a microscopic, like 0.10%. Meanwhile, an actively managed mutual fund averages around 1.15%.
Which doesn't sound like a huge difference at first, like, oh, 1%.
It sounds tiny, but the compounded difference of that 1% fee over 30 years is staggering. It can literally eat up a third of your total potential wealth.
A third? That's insane.
It is. And the advantages of index funds go beyond just the fees. You get incredible simplicity, lower turnover of stocks, which severely reduces the taxes you owe, and no style drift, meaning the fund won't suddenly start taking wild risks outside of its stated goal.
Okay.
And actually, the transparency is getting a massive upgrade right now, too. The SEC recently rolled out a new update, Rule 33-11-125, which requires mutual funds to provide concise, visual shareholder reports using a standardized digital format called Inline XBRL.
Right, which is basically like a digital nutrition label for your mutual fund.
That's a great way to put it.
You can instantly see exactly what ingredients are in the fund without having to read a 200-page prospectus that puts you to sleep. I like to think of it this way. Active mutual funds are like hiring a highly expensive private chef who still might end up burning your dinner.
Yeah, and charging you anyway.
Right. But index funds are a highly reliable, low-cost meal delivery kit.
I like that.
But hold on. If we are looking at the mechanics of index funds, this brings up a huge question for me. If index funds operate on public, preset rules, aren't they basically telegraphing their trades ahead of time?
Yes, they are.
I mean, they have to buy stocks to match the index, and everyone knows exactly when they're going to do it. Isn't that a massive vulnerability in the system?
It absolutely is. And it is kind of the elephant in the room of passive investing. Because index funds must periodically rebalance their holdings to match the underlying index, algorithmic high-frequency traders, or HFTs, can perfectly anticipate those moves.
So they know what's coming.
Down to the millisecond. Let's say a new company is being added to the S&P 500 index on a Friday. The massive index funds must buy millions of shares of that company on Friday to match the index. The high-frequency traders know this.
Okay, so what do?
Well, their algorithms buy the stock milliseconds before the index fund does, driving the price up slightly, and then they instantly sell it to the index fund at that inflated price.
Wait, so they are legally front-running the index fund?
Exactly. They are legally front-running the rebalancing, capturing tiny microscopic profits on massive volumes. In the industry, these are known as losses to arbitrageurs, and it costs index investors between 21 and 77 basis points annually in what's called tracking error.
Wow. So it's like a hidden friction cost.
It is a hidden tax. However, it is crucial to understand that even with this hidden tax taken by algorithmic traders, the remarkably low baseline fees of index funds still make them mathematically superior to active management for the vast majority of long-term investors.
Okay, fair enough. So we understand the vehicle, right? The index fund. Now, where are we actually driving it in 2026? Let's talk about the environment, and I want to start with tax shields.
Oh, tax shields are essential.
Because for 2026, the Roth IRA contribution limits are up to $7,500, or $8,600 if you're 50 or older. This is money that you've already paid taxes on, but once it's in the Roth, it grows completely tax-free forever.
Which is incredible.
It's the best deal out there. You do have to watch the phase-out limits, though. If you're single and your income crosses $150,000, that contribution limit starts dropping. Also, there's this fascinating new rule where up to $35,000 of unused 529 college savings, like money you saved for a kid who maybe didn't go to college or got a scholarship, that can now be rolled over into a Roth IRA without penalty.
Yeah, that 529 rollover is a massive game changer for parents. Utilizing those tax shields is vital to protect your wealth from drag, but choosing the right sectors within those shields is where the actual growth happens.
Right. So what are the sectors right now?
Well, looking at the Morgan Stanley 2026 outlook, there is a massive structural shift happening in U.S. markets right now, and it's entirely centered on the AI power bottleneck.
AI needs a lot of juice.
More than people realize. AI data centers are projecting an unbelievable power demand of 74 gigawatts by 2028. To put that in perspective, that is the power consumption of several small countries combined.
That is mind-blowing.
It is. To meet this, we are entering what they call the Great Grid Upgrade, which requires an estimated $5.6 trillion a year globally just to keep the lights on and the servers running.
5.6 trillion a year. That is a staggering amount of capital flowing into pure infrastructure.
It's entirely reshaping the energy sector. It's driving a literal nuclear renaissance to provide zero-carbon, high-uptime power for these data centers, alongside incredibly strong demand for U.S. natural gas to fill in the gaps.
Now, what about regular oil?
Meanwhile, traditional crude oil is expected to remain relatively neutral, trading in a pretty tight band between $53 and $56 a barrel. Now, looking at the political landscape impartially, as an investor, you simply have to acknowledge how policy shapes this market demand.
Right, because policy moves capital.
Exactly. For example, there are proposed policy shifts right now, like the One Big Beautiful Bill Act, which aims to phase out certain clean energy tax credits. Regardless of political views, you have to analyze how that impacts where the money flows. We're seeing specific funds like ENE1 and NBR3 structuring themselves entirely around these hard infrastructure and energy transition realities.
Here's where it gets incredibly interesting to me, though. If you zoom out and look at the strategy for Indian equities right now, it is a completely different universe.
Oh, completely different drivers.
Yeah, they are running what they call a Magnificent 50 strategy. You have companies like HDFC Bank projecting 16 lakh crore in sales by 2035. And just for scale, 16 lakh crore rupees is roughly 190 billion US dollars.
Which is massive.
Massive. You have giants like Bajaj Finance growing at an incredible clip. But what fascinated me most about the India market source was their systematic risk management rule.
Oh, the PE ratio rule.
Yes. They tie their cash reserves directly to the broader market's price to earnings, or PE ratio. So if the market drops and the PE hits 21, showing that stocks are relatively cheap, they systematically drop their cash reserves down to 12% to aggressively buy the dip.
It's brilliantly mechanical.
It is. The contrast is just wild to me. In the U.S., the massive play is the raw physical infrastructure needed just to keep AI running. But in India, the strategy relies on the sheer unstoppable structural growth of massive domestic consumption by a young population.
And that profound contrast right there is exactly why global diversification is so powerful. Balancing these fundamentally different economic drivers, like the U.S. AI infrastructure supercycle on one hand, and the Indian domestic consumption boom on the other, it embodies the classic 60-40 baseline portfolio philosophy.
Because they don't move together.
Right. You are balancing your risk and your return by ensuring your assets are not all subjected to the exact same economic weather patterns. If U.S. tech stumbles, Indian consumption might still be roaring.
Okay, so investing is fantastic if you have the capital to allocate. You set up your Roth IRA, you buy your globally diversified index funds, and you let the math compound over decades.
That's the dream.
Right. But what if you're starting with literally $0? You can't index fund your way to wealth if you don't have the spare cash to buy the fund in the first place.
No, you can't.
You have to bootstrap. You have to build an asset from scratch.
And that brings us to the ultimate bootstrap strategy. The QuickBooks Guide for 2026 outlines exactly how to build a business asset with zero initial capital. The absolute focus here has to be on personal services, creative freelance work, or digital products like dropshipping or affiliate marketing.
Because there's no overhead.
Exactly. The reason is simple. Zero physical overhead. You have no commercial rent, no utility bills for a storefront, and no raw materials to stockpile. You lean heavily on free community resources instead. Things like your local small business development centers or SBDCs and volunteer mentorship networks like SCORE, or even specialized Reddit mastermind groups to just learn the ropes.
And you also leverage free technology. I mean, you don't need a massive web development budget anymore. You use free trials on platforms like Squarespace or Shopify to build the storefront. You utilize generative AI to draft your initial business plans, generate your marketing copy, and design your brand graphics.
That's all right there.
It really is. And for marketing, you pay $0 for ads. You use organic reach on TikTok and Instagram if you're targeting Gen Z consumers, or you write thought leadership posts on LinkedIn if you're building a B2B consulting service. But, okay, I have to ask the hard question here.
Go for it.
Because the internet's just full of get-rich-quick noise.
Yeah.
Is it really possible to build a legitimate wealth-generating business in 2026 with literally $0? Or is that just a nice internet myth sold by influencers?
You know, it is a completely valid skepticism. There's a lot of snake oil out there. But the $0 startup is not about getting rich overnight. It comes down to one crucial concept, and that's validation.
Validation?
Yes. Bootstrapping with zero money using AI and free social media tools allows you to validate your business idea in the real world without taking on devastating financial risk. You aren't taking out a $50,000 small business loan, building a product in secret, and just hoping people want it.
Which is how it used to be done.
Exactly. Now you are using free tools to prove they want it first. Once you have that market validation and you generate your first bits of actual cash flow, then you have the leverage to attract funding, get a loan, or bring on partners to scale. The $0 start is simply a risk-free mechanism to validate an asset that you own completely.
Wow. Okay, let's take a breath and recap this journey because we have covered incredible ground today.
We really have.
We started by recognizing the weightlessness of modern money and rewiring the brain against digital financial amnesia using PFM apps and gamification.
Right.
Then we talked about crushing the psychological burden of debt with the Snowball method. We built a wealth engine utilizing low-cost index funds inside the tax shield of a Roth IRA.
The path to wealth.
Yep. We explored the massive capital flowing into the 2026 U.S. AI energy grid and the booming Indian consumer markets. And we finished with the ultimate $0 bootstrap to validate and build your own business asset from scratch.
And, you know, the connective tissue for all of this, the reason you take any of these steps is relevance to your daily life. Whether you are downloading a budget tracker today, opening a secured credit card to fix your utilization ratio, or rolling over an old 529 plan, every single one of these actions is buying you the ultimate luxury.
Peace of mind.
Exactly. You are buying peace of mind for yourself. You are buying relief from that crushing, chronic, daily anxiety of living paycheck to paycheck. You're taking control back from a system that essentially wants you distracted.
I love that. But as always on this deep dive, we can't let you go without a final, slightly provocative thought to chew on.
Naturally. And this raises a fascinating, almost paradoxical question, which was actually brought up in the Wikipedia source regarding a concept called asset manager capitalism.
Asset manager capitalism. Okay, what is that?
Well, we just spent time discussing how brilliant and mathematically efficient passive index funds are for you as an individual.
Yeah, the low fees, the simplicity.
Exactly. But if everyone on Earth follows this golden rule of buying passive index funds, a few massive asset management firms, the ones running the funds, will eventually hold all the voting power across all public companies.
Wait.
Yeah. They are effectively buying the entire economy. Because they own massive shares in every competing company within a sector, say every major airline or every major bank, they could theoretically use that voting power to create monopolies, drive up consumer prices, and cause widespread wage stagnation.
Because they own all the players on the board.
Exactly. They don't care who wins, they own the board. It leaves us with a profound paradox to ponder. By seeking our own passive financial freedom, are we inadvertently handing total, unchecked control of the entire economy to a handful of mega funds?
Oh man, that is a heavy, mind-bending thought to leave you with. It brings us right back to where we started, really. Money might be invisible and entirely weightless on our screens today, but the gravity of how we use it, how we save it, and exactly where we invest it shapes the entire physical world around us. Thank you so much for joining us on this deep dive. Stay curious, keep validating your ideas, and keep building your stress-free wealth. We will catch you next time.